United Health's stock has dropped more than 10% in the last 1 month, while the S&P 500 is actually up. A lot of you have been asking why this is happening and whether this is a buy, hold, or avoid situation. So, in this analysis, I'm going to break down exactly what triggered this fall, what the company is dealing with right now, and whether this dip is worth taking seriously. Let's start with the basics. In the last 30 days, United Health is down around 10.6%, while the broader market is up 1.4%. What makes this even more confusing is that the company actually reported better than expected Q3 earnings. So the natural question is why the stock is being punished. The answer is simple. This has nothing to do with earnings. This is coming from structural pressure across the entire US healthcare system. The United States administration is pushing healthcare companies to lower healthcare costs, offer more services, and operate under tighter margins. Every part of the healthcare ecosystem is feeling this pressure: insurance companies, pharmaceutical companies, medical service providers. But for United Health, the impact is massive because they serve more than 150 million people. Costs are rising quarter after quarter, but the company cannot adjust pricing in the middle of the year. That creates margin compression. So even though revenue is stable, profits are getting squeezed, and Wall Street always reacts negatively to shrinking margins. Now let's talk about what management has said. Analysts have already downgraded the stock because they believe margins may remain weak next year as well. But United Health's management has made two major decisions. First, they will raise prices next year when the new pricing cycle begins. This matters because this year they were stuck with old pricing even as costs jumped. Second, the company said it is willing to lose some customers if those customers are too expensive to serve. And honestly, that's a smart move. A business should not serve customers where the cost to serve is higher than the revenue it brings. Let me explain this with a practical example that makes this easy to understand. Imagine a delivery company that has a distribution center inside a major city like Chicago. Delivering within that city is fast, simple, and cheap because everything is close. But if the same company tries to deliver that exact same package from a center located hundreds of miles away, let's say from Kansas, the cost becomes much higher. The customer is the same, the package is the same, but the economics are completely different because the service area changes the cost structure. Healthcare works in a similar way. Some customer groups require far more resources, effort, medical attention, or support. Those customers become expensive to serve. United Health is now focusing on the segments they can serve efficiently and profitably. This is actually a healthy decision for long term shareholders. But we also need to talk about what went wrong this year. United Health made one major mistake in 2025. They underestimated how fast medical service costs would rise. Costs went up aggressively mid year, but the company couldn't adjust prices because the pricing cycle was locked. As a result, margins dropped sharply. Earlier this year, the stock had already fallen nearly 50% when these issues first came out, and this recent 10% drop is just a continuation of the same fear. The positive side is that next year pricing resets and that gives the company room to recover margins. Now let's talk valuation. Based on the valuation models I reviewed, the fair value estimate for United Health is in the $460 to $470 range. I'm using $464 as a midpoint reference even after adjusting for higher risk. Regulatory pressure, cost uncertainty, and margin compression, the stock still appears undervalued at its current price around $330. To cross check this, I also looked at market multiples. At the moment, the forward price to earnings ratio for United Health is around 19.7, and the forward price to operating cash flow ratio is around 14. Both of these metrics point toward undervaluation. Usually, one metric shows undervaluation and another shows overvaluation, which creates confusion. But here, both metrics are pointing in the same direction, which gives more clarity. So, here's my conclusion. For me, United Health is a buy, not because the stock has dropped, but because the fundamentals of the business remain strong. The pricing reset is coming soon, the customer mix is improving, and the majority of the risks are already priced in. I have been positive on United Health since the major crash earlier this year, and nothing in my analysis says I should change that view today. If you want more deep dive breakdowns like this every day, make sure you subscribe. Comment which stock you want me to analyze next. This is Vikram Singh, and I'll see you in the next analysis.